Thank you, Mr. Chairman. Good morning, Chairman Powell. Thanks for joining us. I do want to stress how encouraging the recent economic data has been. Actually, for a little while now, we had a tremendous increase in personal income in the month of April, for which is not terribly surprising. But the May employment number was very surprising and very encouraging. Retail sales today was really good news. So I'm not for a minute suggesting that we're out of the woods, but the anecdotal evidence has been very, very encouraging. And I would just remind my colleagues, there's no such thing as a free lunch. And we have authorized uh, several $trillion of government spending in a variety of ways, and much of it has not yet even been spent. So I think we should be very, very careful in evaluating what's necessary before we go forward. Mr. Chairman, I want to talk about corporate bond buying because when we put together the CARES Act, the concept of funding SPVs so that they could go out and buy corporate bonds, whether through ETFs or whether through a new Fed-created index or directly, there were always two reasons for having this capacity. One was to ensure the smooth functioning of the markets. And for that, the mere existence of these programs has been remarkably successful. We've seen record volumes of corporate debt issuance. Clearly, the corporate bond market is functioning and functioning very, very well. The second possibility was to provide liquidity to a company that's fundamentally solvent, but facing a serious liquidity problem because of the nature of the moment. It seems to me that continuing broad-based corporate buying of bonds now, and including setting up yet a new index for doing so, doesn't serve either of those purposes. Those needs are being met, and I worry that it starts to look a lot like fiscal policy, or it starts to look a lot like the goal is to lower spreads, despite the fact that nominal rates are incredibly low. And it certainly seems to me that this kind of activity at a time when the markets are already functioning smoothly and we're not addressing individual borrower needs, but rather making these broad-based purchases, we run the risk that we diminish price signals that we get from the corporate bond market, which can be extremely important in enabling us to detect problems. So I'm wondering why we need to be continuing a broad-based corporate bond buying program now, and what's the exit strategy on this?
So I certainly hope it doesn't have those negative effects you mentioned. This is something we said we would do at the beginning, and you pointed out that markets reacted very strongly to the announcement. That's because they believe that we'll do what we say we're going to do. So one reason, I wouldn't say it's the main reason. One reason is, though, we feel that we need to follow through and do what we said we were going to do. So that
could I just on that? My impression had always been that it was a contingent thing, that this would be there as needed and would be used as needed. But if it's not needed, it's not clear to me that you have to use it anyway to show that you're willing to use it. I don't think anybody doubts your willingness to use it.
So we're not actually increasing the dollar volume of things we're buying. We're just shifting away from ETFs toward this other form of index. And as we've said, and if you look at the FAQs, frequently asked questions we published associated with this change, it's really going to depend on the level of market function. If market function continues to improve, then we're happy to slow or even stop the purchases. And if it goes the other way, we'll increase.
Is there a problem with market functioning now in the corporate bond market?
Market function has improved really substantially, and that's why you see very little demand. In fact, so far, no demand at the primary market facility. We originally thought that was where the demand would show up. So we're just, it was out of an excess of caution to preserve these gains for market function by following through. And I don't see us as wanting to run through the bond market like an elephant, doing things and snuffing out price signals and things like that. We want to be there if things turn bad in the economy, or if things go in a negative direction. We want to make sure that we're there. Also, with the ETFs, remember, it's a very small part of the market. the actual bonds give us a better purchase should we need it. We clearly don't need it now.
That's my real point. I mean, I get the argument for creating a broader index than a given ETF, but it's not clear to me that the Fed needs to be intervening actively in the corporate bond market right now. But let me move on to another issue. Last week, my understanding is you suggested that the Fed might be considering whether to adopt yield targets, which really means, let's face it, that means yield caps. Um, I want to discuss that a little bit. I'm very concerned about that. First of all, the idea of manipulating treasury yields to keep them lower than they otherwise would be involves lots of potential problems. It's clearly picking borrowers over lenders. It creates problems for insurance funds and pension funds, distorts price signaling. So, and I don't know how you get out of that. So, do you have any more thoughts on the idea of establishing yield targets on the Treasury curve?
Sure. So this is something that we've never done. Actually, that's not true. We did it after World War II and during World War II and into the early 50s. We haven't done it in the modern era. A couple of central banks, Bank of Japan, the Reserve Bank of Australia, have done it. So it's a tool other central banks have chosen to use now. And what we did at the last meeting was just brief people up on the history of it and really how it works, so that people understand the technology and that sort of thing. We've made absolutely no decision to go forward on it. You've seen some of my colleagues have given speeches lately raising questions about it. So it's not a decision that we've made. You know, the sense of it is that if rates were to move up a lot and for whatever reason, and we wanted to keep them low to keep monetary policy accommodative, you might think about using it, not on the whole curve, but it's on some part of the curve. And it's not a decision that we've made. It's sort of an early stage thing we're evaluating.
Thank you, Mr. Chairman.